In this video, I'll be going through Work Together, Chapter 15, Lesson 2, problem from our Century 21 accounting textbook by Gilbertson, Lehman, and Gentene, edition 10E. So all credit for this problem, as well as this entire textbook given to them. So in this problem, we are journalizing the adjusting entries for merchandise inventory and interest receivable. So using our general journal and unadjusted trial balance from Work Together 15.1 right here, I will guide you through the following example. And, keep saving your work. We're going to use this same workbook 2 more times in these Work Together problems. So, number 1, from a physical count of merchandise inventory, the December 31st balance is determined to be $96,471.25. Journalize the adjusting entry for merchandise inventory. So here's what we know. If we look at our textbook, we'll remember that the debit goes to merchandise inventory and the credit will go to income summary, and that is the case if the amount increased. So let's see how this amount changed. $96,471.25 is what the count is, and according to our trial balance, I guess we can look at for merchandise inventory. Let's look up here, merchandise inventory. It was at $94,845.31. So what we know is it increased. It didn't decrease. So because it increased, we've got to debit merchandise inventory. So let's go ahead to our general journal. We would, on the 31st, another adjusting entry, debit merchandise inventory, and we would credit income summary. All right, the amount of that is going to be the change between what our count was and what was in the balance already. So our count was equals $96,471.25, and then we are going to subtract the merchandise inventory balance that was there, $94,845.31. Hit enter. So the change is $1,625.94, and that is the first adjusting entry. Next adjusting entry. A single note receivable is outstanding on December 31st. The 90-day 8% note was signed on November 22nd. Journalize the adjusting entry for interest receivable. Okay, so here we go. We know it's on the 31st, and we know that our entry will be a debit to interest receivable, and it will be a credit to our income account, interest income. Now we just have to figure out the amount, right? So what we know is it was 90 days, 8%, note was signed on November 22nd. So we know the amount of that note because we can look at our balance. Balance in the trial balance for notes receivable, right? And we can see that that's $8,000. So we know the original principal is $8,000. What else do we need to know to figure out the interest? So it'd be equals the principal of $8,000 times the interest rate, which is 8% or 0.08, times the number of days of this note that are in this year, right? So it's a 90-day note signed on November 22nd. So it'd be 22nd to 30th would be 8 days plus, 31 days in December. So 8 plus 31 would be 39 days. 39 out of the 360 days banks like to use as a year. Hit enter. We get $69.33. So we'll just enter that amount down in the credit too. And we have now journalized our adjusting entry for interest receivable. That is it for 15-2 Work Together, and I'm fairly confident that you can complete on your own. Just be very careful to follow the way you do the formulas. Don't get tricked into using, 90 days for the note instead of 360. You still have to use that whole section of a year to calculate your interest. So, good luck.